I know you mentioned you started out with single family and what got you
Yep.
expanded into multifamily.
Yeah, so I got started in real estate back in 2006. I was actually a partner in another business that we ended up selling in mid 2006. And at that point, I knew the real estate was a good investment, but it was all new to me. I was young, I was 26 at that point. And so I had just started acquiring my own personal rentals, just small single families. Now, I did it in the affordable housing space, which I don't recommend anyone do for new investor. I learned the hard way that subsidized housing, affordable housing is a tough market and asset class to be in. But I learned a lot of good things too. And I just grew my personal portfolio between 2006 and really 2013 while I was involved in some other business ventures. My portfolio grew from single family into kind of smaller multifamily through that time. In about 2013, I had exited another business of mine, a manufacturing firm, and about 300, a little over 300 doors under ownership at that point.
Mm,
And I didn't know what I was going to do after that because I was sitting around going, okay, what's next for me? And to me, it made sense with real estate because it provided me the cash flow and the profits and the appreciation to continue to grow my other businesses. So it made sense to just go all in on real estate at that point. So in 2014 is when I officially founded Sim Capital with my personal portfolio. And then we just expanded upon there. And at first, it was really just friends and family. And then other people started taking notice of what we were doing. We were buying bigger properties, 50 units, 75 units, 100 plus units. And we went all in on multifamily at that point because we saw there's just a lot more opportunity, right? It's a lot easier to manage a single property with more doors versus a 300 door portfolio of single family homes. And our big model or our business model was all value add. So we were focusing on class B minus stuff that we could really come in and add heavy value to force appreciate the property. And it just grew from there. Our very first raise we ever did was 5 million. And now we're doing $50 million raises in our
wow.
funds that we open up. And it's just grown over the years. And we've gone full term on 3 funds. We've done 7 funds total to date. We've done about 32, I think, different project properties like big multifamily. And then we have our affordable housing fund that we have, which we call our cash flow fund, which focuses on single family and small multifamily affordable housing subsidized asset class.
Wow. Very good. That's amazing growth. So the 7 fund that you've done, are they all multi-asset fund? Are they single asset fund? Are they, yeah.
Yeah,
How are
yeah.
they?
So most of them that we do are multi-asset funds. We've done a few individual syndications over the years. In fact, we did one last year. We bought a 216 unit property in Oklahoma, and that was a single asset syndication type of deal. But we like the fund structure majority of the time. And our investor base seems to like that as well. They like to have that diversification. A lot of them don't want to have to worry about picking and choosing which asset their dollars are going to go into. And just it seems to work well for us.
I see. Let's dive into that because a lot of people on this call do syndications or single assets. And so let's dive into sort of some of that pros and cons from the sponsor's perspective in your case, and also from the investor's perspective. And yeah, so what had you choose to get into the multi-asset fund to begin with? And what, yeah, and then when you let's start with that. Let's start with that and then have
Sure.
follow-up questions.
So for us, or for me, my decision was based on how I structured my personal portfolio initially and how I had it under one main LLC that was operating all under that umbrella. And honestly, the very first fund I launched, we did it as a multi-asset fund simply from a lack of education. I'll be 100% honest with you guys. I didn't know any better, right? And so I'm like, okay, this makes sense. Let's do it this way. But it worked. There's more moving parts to it, obviously. There's more to manage. There's a lot more accounting that goes into play here because you actually obviously have multiple assets that have to be distributed across the fund and the investors and the LPs. But we like that structure personally because it's just what we're used to and it allows us to go out and raise continuously, not like an evergreen fund, but it gives us a larger raise to continuously raise on and be able to show investors the growth of that fund from the start, the assets that we have and the assets that we plan on adding and when we plan on closing it out. So for us, it works. It's just what we're used to and it works well for us.
I see. Okay. And so, like, when it comes to raising money for a multi-asset fund versus a syndication, have you did mention your investors like the diversification, but for a lot of people, raising for a blind pool fund is much harder than so that's
Mm-hmm.
why a lot of people raise individual single asset. Can you
Yep.
expand into that? Can you talk about that?
Yeah, it's definitely a tougher raise for most people because most people, to our raise that we did last year, which was a single asset syndication, it's a lot easier to show what you're buying, right? This is what we're buying. This is its current occupancy. This is current status. This is the business plan. This is the timeline, et cetera. And so with a lot of investors, especially if your target market is your Main Street investor, your high net worth individual, right? They like to be able to see the details. They want to see what their money's going to. And we still have that objection when we're raising on a blind pool fund. But at the same time, we also have found that there is an investor base out there that they don't want to have to pick and choose. They trust the operator. We've built a rapport with them. We've built that foundation. We've built that trust. We can show them the track record of the funds that we've done to date and how we've exited 3 of the 7 total. And that builds the trust with them to say, okay, you know what? Here, I'm going to give you this chunk of money. You deploy it as you see fit. And again, they like the diversification. Obviously, there's tax benefits with multiple assets within a single fund. And it allows us, and I will say one of the benefits to us and one of the ways that we're able to sell it is we all know in real estate, nothing ever goes as planned, right? No matter how on top of everything we are, there's always surprises, right? And it could be the condition of a property, the condition of the units. It might be your value add renovation plans take longer than expected. You might have material delays. You might have permitting delays, whatever it might be, right? And what we like is in a multi-asset, the performing properties help to offset maybe a property that you don't get turned around and performing as quickly as what you originally expected. And so that's the diversification that a lot of our investors like with the multi-asset fund. Now, again, with that said, you're always going to have investors that don't want to say, hey, just take my money and deploy it how you see fit. They want to pick and choose what asset their dollars go into. And that's why we'll do a syndication from time to time. But we'll also tell people like, look, we don't have any individual syndication coming up. We're probably not a fit for you if that's what you're looking for.
I see. Very good. From your perspective, when do you decide, hey, let's put this property in the fund, or hey, let's raise this individually?
Yeah. So for us specifically, if we have additional properties in the local market that we're looking at that property in, for instance, let's say Oklahoma, right? Oklahoma last year was a new market for us. And we didn't want to put that into a fund that we have properties that are in
Mm,
North Carolina and South Carolina, right? In that geographic area. And so for us, we'll put that property into individual syndication with the idea that we're going to grow in that local market and eventually buy more properties, but then do it in a fund because we're familiar with that local market and the geography and the demographics and stuff like that. So if it's a market that we're already in, typically we'll roll that property into the fund as a whole. If it's a new market for us, typically we'll do it on a syndication basis.
I see. Very good. And talk a little bit about your buy box that you put into your fund, and then how many assets do you typically put into a single fund?
So buy box for us is typically 200 units or more. We need it to be a class B. If we can take it from a C plus to a B, we'll entertain that as well. But definitely 200 units, definitely class B. There has to be a lot of value add because our typical time is about 3 to 5 years. We're not holding anything for much longer than that. So we want to be able to come in, heavy value add, stabilize the property, increase operational efficiencies, rehab the units, increase curb appeal, stabilize the property, and then manage it efficiently for the remaining time, and then be able to get out of it. So those are the 3 big things for us. As far as price points go, for us, it's really geography based because what we can buy in Oklahoma, for instance, we can't buy for the same pricing in North Carolina, for example. But we've bought anything from 10.5 million up to 65 million. So it really just price point wise, that's not a huge determining factor. It's really, is the value add there? Can we get the value out of it that we expect to? Does it meet the unit criteria? Is it in a growing market? We want to see population growth, demographic growth, income growth, stuff like that.
I see. Okay. And then how many properties you typically put into one fund?
So we don't have a cap. We like to limit the fund to about 100 million.
Okay.
So as much as we can fit into a fund up to 100 million, we'll do. So that could be anywhere from sometimes it's 4 properties, sometimes it's 8, depending on the demographic and where those properties are actually located.
I see. Very cool. You got started in 2006. You've been through the last
Mhm,
market crash. You really this
mhm.
wave up from 2013 until now on the apartment syndication side. I'm curious, do you have deals, especially that you bought in 21, 22, that have been challenging?
It's funny you say that. We did not buy anything in 2020, 2021, or 2022. So we
Oh,
went three
wow.
years that we didn't buy anything at all. Our focus, especially during COVID, during 2020 and 2021, was
Hmm.
really maximizing the efficiency of our portfolio as much as we could. We don't go heavy leverage. Typically, we're 60, 65% LTV. And a lot of the properties that we had in our portfolio up to that point, we had stabilized. So we got that big price appreciation and value increase, and we had a ton of equity. So we did some refis on some of the properties. We returned capital and distributed some profits to investors. But we didn't buy anything during those 3 years because, as you saw, the gap between buyers and sellers, what they were wanting, it was just so hard to bridge, and deal flow dried up significantly. We looked at some during 2020, 2021. We actually did go under contract on one, and then we actually terminated it during due diligence because we uncovered a lot of stuff that just were big red flags to us. And coincidentally, that's actually when we pivoted to building out the affordable housing fund that we have now. Because for me as a business person, I want to see growth consistently, right? Especially being in this as long as I have. And a lot of people were just sitting on the sidelines. And I was sitting on the sidelines, and we were sitting on the sidelines for multifamily, but I still wanted to see growth. And so my whole thing was like, I'm just going to go back to what I cut my teeth on in affordable housing and workforce housing and build a fund around that because it's something new. You don't see it a whole lot. Multifamily space is dried up. Obviously, we know commercial was like it hit a brick wall. And so that allowed us to keep our growth going, continue acquiring properties for that fund, continue fundraising, and keep our foot on the gas.
I see. Very good. I'm glad you didn't buy anything during that market. But
I
yeah, I'm
mean,
surprised you. I was gonna say I'm surprised that you refied them instead of sell them because like they were like at the height of the market.
yeah, there were some good properties for us though, and we felt that there still was some room. And like I said, we didn't own anything. We don't own anything for more than 5 years. Sometimes we'll carry them over to 6 or 7, but we just felt that refining them and keeping good performing properties in the portfolio made more sense than selling them because we weren't sure if we were going to be able to deploy capital out at that point into other properties to replace those.